Hello, Ramona. I can't shake the simplest feeling beyond the ghost. We stand on the opposite shore. Hello, Ramona. I reach through mysterious ceilings, my only hope. I look for the things I don't know.
Hello, DMV. This is Ramona Jones McClain, and we are coming to you live from our Podbean channel. If you do not have podcasts, you got to sign up. And we're also streaming live on Facebook as well as Instagram and YouTube. So check out our YouTube channel. As you know, here at the Insurance Guru Show, we talk about all things insurance. If you want to call in, you can go to Facebook. There's a link and go to the podcast. You can call in through the podcast. We prefer you do that, but if you want to call in, you can also call in at 443-660-7131. That's 443-660-7131. Here on the Insurance Guru Show, we talk about all things insurance. Yay! Now, we know that right now in the insurance market, I'm just going to be honest with you, people are experiencing increases to the amount of from 4% to 24 and 40%, depending on what insurance company you're with. There are quite a few insurance companies that are not writing new business, that are going through experiencing a situation where they do not want to experience growth. And that's very rare. That means that the book of business that they have right now in their situation is so big, they don't want to bring any more business in because of this statistical relevance of losses. That means if they write more people based on the current loss ratio experiences, they will not be able to pay claims. So they are no longer writing new business for right now. Those who are on the books, you're experiencing huge rate increases, and a lot of people are saying, based on what? Because in the past, it's been I had an FR accident, and if I had an FR accident, my rate goes up 10%. My second accident, it goes up 40 to 50%. The reason why your rate is going up now is credit. Since I would say the year 2008, credit has had a huge factor in how much insurance you pay. The reason, one of the biggest reasons is they find that individuals who do not have good credit tend to be less stable. They tend to put in more claims, and they tend to put in more fraudulent claims. And when I say fraudulent claims, they tend to escalate claims larger than what they normally are. And so you put a claim in for, I don't know, a little nick that you got on your door, and you try to include the fender as well, and a claim that should have cost $500 is now $3,500. Um, and that's what's found when you deal, and this is just statistically what happens when you deal with credit. They don't want this to happen, but it's kind of the case. So who I have with me today, I have Mr. Ron Thomas from All Financial. He is located in Owings Mills. Just a second, I'm going to get his address for you. Okay, yes, he is located at 109 89 Red Run Boulevard, Suite 210 in Owings Mills, Maryland. Ron, hello, how are you?
Good afternoon. Thank you for having me. I'm doing great. How about yourself?
I am doing absolutely wonderful. So I understand from a mutual friend of ours that you are the credit guru.
I don't mind. I don't mind when they talk about it. I've been called worse than that. So yeah, absolutely.
And so,
um,
one of the biggest issues that's affecting car insurance these days, I mean, honestly, um, the way car insurance works, you have tier one, two, and three.
mhm,
60% of determining what tier you even fall in before they even factor in any other rating classifications is credit. If
mhm.
your credit is above a certain amount, you can automatically go into tier one, and then you're layered down based on experience, location, drivers, the age of the driver, occupation, all of those things. But the first thing you do is you go into a tier based on your credit. And we
Yep.
know credit, especially when the African American community, is a big factor and something we constantly overcome. I'm not gonna say that they can see that we black, but
We're having an open conversation, so we might as well keep it all the way real, right?
right,
Yeah. So, in my opinion, your credit is your financial DNA. That's your bloodline. That's what you've done up until this point. So when somebody looks at your credit report, you're telling them who you are financially. It's almost as if you having a kid and he looked just like you. You can't deny your lineage, right? You can't deny your blood type. So this is the same thing as your financial DNA. And just like insurance, just like my business, I mainly focus on the mortgage business, but there's a huge concentration in insurance because every homeowner needs to have homeowners insurance. And basically, what's happening is when you have somebody run your credit in order to give you pricing, whether it be car insurance, whether it be buying a car, whether you be buying a house, or you're getting a quote, when somebody runs your credit, you're asking somebody to extend something to you, right? And you want the best price possible. So what they're doing, what these companies are doing is they are gauging their risk level. How risky is it for me to go ahead and give you car insurance?
right,
How risky is it for me to go ahead and extend you a loan? So car insurance is a loan because without car insurance, you can't drive, and they have the capacity to tell you your premium is 180 a month, and they have the capacity to tell you your premium is almost $400 a month. I
right.
guess it goes back to your driver's record, but when it comes down to your credit, the credit tells people, tells lenders, tells insurance companies how responsible is this individual. When
Exactly. And
when
insurance is all about determining risk.
mhm.
Is projecting risk, is determining what is the likelihood in the next 5 years you're going to have or experience a catastrophic loss. And
Ramona, let me ask you a question. Okay. Let's say that you
yeah,
have you have two you have two siblings, okay? You love them both the same. Okay. One sibling you lent $5,000 to 3 years ago. It took them 2 years to pay you back, but they paid you back in full. And then the last time they gave you the money, they gave you a little bit extra and say, hey, I really appreciate you giving me this money. I'm back on my feet. You helped me out. Right. And then you have sibling two, you love them to death. You lent them $5,000 3 years ago, and you're still waiting for the first $100 back, right? You still love that person, but when the next situation comes about, who are you more inclined to help out? You know?
but see, that's a tricky question because that's a faith-based issue for me, not a financial one.
Well,
First of all, I make it a habit of saying never borrow money because if you could pay it back, then you wouldn't need it in the first place. So don't give it if you expecting it back. That's just
no,
me.
no, I get
But
what you're saying.
secondly, your likelihood, but if I'm looking at it from an objective standpoint, the person you're going to give the money to is the one that, for me, this just be for me, the number one, is not going to use it frivolously and going to actually turn it into something that may make money,
Hmm.
because that's a whole nother show. We're
Right,
going to talk about that another month.
right.
or it's going to create an environment where they can produce the money and bring it back to you.
Right, right.
Mm-hmm. Yes. So I think we lost Ron. And being able to pay back is a good factor in determining whether or not you are a positive risk. Because if you can't pay the money back, if you're going to cheat because you need money, if you're dealing with issues in which even if you go without eating to pay the money back, as long as you pay the money back, as long as you're honest and upfront with people, and that's how you do best in determining risk. You still there, Ron? Okay, there we go. I got you. Good, good, good. I'm sorry. So I was telling them, of course, you're gonna want to give the money to the person that you want to pay back. That's gonna pay you back.
Okay.
Ron, can you hear me? Okay. Can you hear me, Ron? Okay. So, Ron, let's talk about the behaviors, because credit is something that is learned. Credit is something that is learned. Here he is. Credit is something that is learned. There we go. We back, Ron?
Sorry about that. I gotta
That's
just
all
fix
right.
my camera real quick. Okay. I don't
So
know what
I was
happened,
just
but we got a
saying
little.
that credit is a learned behavior. It's not innate, but because different cultures teach it in different ways, it is something that if you understand what the rules are, you can understand how the game is played. So a lot of people start off, how about they got their credit card in college and they never paid it back? And
Right.
now that thing is sitting on their credit, and that's the only thing on their credit, and they're trying to go out and buy a car, or they think they can get in an apartment, or they're trying to buy a house. And of course, their risk determination is high, and it's driving their cost up, which always baffled me. If in fact, but I do understand that the reason why the price is higher if your credit is lower is because the companies want to get as much money from you up front as they possibly can, because the fact that you may default is greater than someone with a better credit score. But can we talk about what we can do to improve credit?
Absolutely. Okay, so I'm glad you brought that up. So when I think about credit, I think about this pie chart, right? A round circle, and then when you look at that pie chart, you're gonna notice that there are two things in your credit profile that hold the most weight, the most percentage. These are the things that you can work on in order to improve your credit the easiest, and they have the biggest determining factor of what your credit score looks like. So 35% of that entire pie chart is going to be your payment history. Okay, how do you pay your bills monthly? Do you have any 30-day lates? Do you have any 60-day lates? Do you have any 90-day lates? These late payments are actually the largest determining factor when it comes to your actual credit score. So if you don't have any late payments on any accounts, you're in the best position possible. Obviously, a 60-day late is worse than a 30-day late, but these are all gauges on somebody borrowing money but not being able to pay it back on time. So paying
Right.
on time is huge. Okay, so let's say that's 35%. Then you have 30% of your credit score, which is the second largest piece, is going to be called your credit utilization. Now, this is only going to matter for credit cards, maybe a home equity line of credit, revolving accounts. The credit bureaus, you're able to borrow money in two different ways. You can either get an installment loan, which is like a car loan. You have 5 or 6 years to pay it back. You pay every month, either 60 or 72 payments, and it's paid in full. On to the next. And then you have your revolving accounts, which are credit cards. They give you a credit limit for maybe 5,000. You're able to use that money as you pay it back. You can utilize it again. The revolving accounts are what you really want to pay attention to as far as credit utilization. And credit utilization means that if Capital One, for example, gives you a credit
card for, I don't know, $800, and the rule of thumb is that you keep the credit card usage under 30%. So what's 30% of $800? 3 goes into 8, what, 2.75 times? So the rule of 240. So if your credit usage is, if your limit is $800, then your credit usage should stay under 30%, which is $240. And anything above that, you start to encroach up, and they think you're basically using too much credit. And it doesn't mean that you can't charge something up higher than that. You just need to push to get the credit usage down below 30%, because that paying on time and utilizing under 30% of your credit limit allows them to give you a good credit score. It puts you in a position where it says you can manage your credit for you. We keep losing Ron. So one of the other things, of course, that affects credit is let me see. There you go, Ron. There you go. I just kind of explained it to him, the credit utilization. But please continue, sir. Yes, sir. Go ahead, Ron. There you go. Okay, so we were talking about credit utilization. Okay.
Ooh, I'm so sorry. I'm not sure why this thing keeps
Go
cutting
right
out.
ahead. We were
I
talking about
apologize.
credit utilization.
So yes, credit utilization. I'm not sure what you last heard, but the important part is that the revolving accounts is what you want to pay attention to. And if the credit bureau, if a Capital One gives you $1,000 credit limit, you want to keep that utilization at 25% or lower. So that 10 days after you make your payment, Capital One is going to report your balance to Equifax, Experian, and TransUnion, and you want that balance to be at 25% or less. That will ensure that you're going to get the best reporting from the credit agencies, okay, and therefore help to improve your score. So you got 30% credit utilization, you got 35% is payment history, okay, you have another 15% for age of how old are these transactions, okay?
Right.
This will bring me to a really important point that I'll just touch on. If you're having trouble establishing a good credit score, it's because the accounts that you're opening don't have a lot of age to them. There's not a lot of history to them. One thing that I can suggest is that if you have a family member that has good credit, you can help increase your credit score by asking that family member if they will allow you to be an authorized signer on one of their credit cards. Now, you can become an authorized signer on a family member's credit card and you never get a copy or an actual physical credit card. All you're doing is just benefiting from their age and old history, which is always good. Now, of course, you don't want to ask somebody with poor spending habits and high credit limits to be an authorized signer because you want to take advantage of the benefits of their good credit history. All right, so I don't know if you have anything to add to that, Ramona, but you're talking about 35% payment history, 30% credit utilization. That puts us at 65%, and then 15% is going to be the age of these transactions, the age of your credit reporting. Okay, that puts us up to 80%, and then the other 10% and 10%. So we have 20% left. 10% is going to be the amount of credit inquiries that you have. How many times are people pulling your credit in the last 6 months? The more credit inquiries that you have over 6 months, meaning the more people that you say, yes, go ahead and review my credit, that starts to hurt your credit score. So that'll be another 10%. And then the last 10% are going to be public records. If you have any collection accounts, bankruptcies, foreclosures in the past, those are going to play a huge determining factor in what your credit score is as well. So what I tell most people is make sure you pay on time and keep your credit card balances as low as you possibly can 10 days after the credit bureau. Pay on time, keep your balances low, and you're on the way to having a great credit report. If you're lucky enough to have a family member and you can ask them to be an authorized signer, then you can expedite getting your credit report increased and ultimately getting a lower auto insurance premium.
Yeah, so I got a question that came in from, let me see, Mr. Bobby Timble. Mr. Timble is asking, what can I do if I do have credit, but it's only been for a couple of years?
What are your? My main question would be, it would be a situation where I would look at payment history, because you can't change your payment history. All you can do is make sure that you start paying on time moving forward so that that old payment history can get behind you. I do not suggest closing accounts at all, because that will hurt your credit score before helping your credit score.
And that's something I want to bring up, because I had accounts with Synchrony Bank, and what they were doing is if I didn't use them, they were closing them down.
Yeah.
And that irritated me to no end. That set me back when I was trying to refinance my building. And what I ultimately ended up doing, this is just another little tactic, I ended up going to my other carriers that I had cards with and asking them to increase the limit, which allowed my utilization to go back to where it was before Synchrony Bank. And yes, I'm saying Synchrony Bank on air. Started, it was I used to have a Joanne Fabric sewing machine, and I used it quite a bit because I have a couple of sewing machines, and then I just didn't need it for a year. And when I didn't use it, they just shut it down. And then 4 months later, they shut down my QVC card because I wasn't using it. And I'm like, oh my gosh, like I'm in the middle of trying to refinance my building and they're messing with my credit score.
Yep.
And that hurts. You can't call them and talk to them.
No, I know exactly what you mean. I for just a quick similar experience, I had a credit card charging me like $8 a month just because when I got the card, it was 10 years ago and I had challenge credit. I'm human. I had some credit, so I was rebuilding, and this is one of those credit cards, and I'll call out their name, First Premier. They allow you to get some credit if you have some challenge credit, but they make it hurt. They charge you $8 per month, which doesn't seem like a lot, but if I'm not utilizing the card, my choices are either pay this $8 a month or close down this credit card, because at this point, it doesn't make sense. I've got an American Express card at this point where it doesn't charge me the annual fee. I get a ton of perks, and the interest rate isn't so bad, so I don't want to use this card. But they're like,
love your Amex. Oh my God.
Oh God.
Use my points.
Use your
Order
points.
something on Amazon.
Yeah.
Oh my gosh.
Delta, I fly a lot, so you get the Delta privilege. You get to go into the private rooms in the airports and get first class service, So those are the benefits that a real credit card, but Amex is not giving you a credit card if you have challenge credit, right? Not even a shot. So you got to establish and build up to that point. But anyway, I chose to, instead of pay $8 a month for a card that I'm not ever going to use, I called them first and said, listen, I'm going to close this card for good if you don't stop charging me. What are you guys willing to do? They said, this is my policy. On top of that, there was like a $99 annual fee. So in the beginning, when I was establishing credit, I was willing to take the lick, willing to take the hit and say, I don't mind paying this extra because I know credit is more important than cash in the end
Right.
result. So I got to get my credit right. Anyway, I ended up canceling them. My credit score dropped 50 points as soon as I closed that card because I lost 10 years of payment history, 10 years of a good account that I was never late on. I just refused to pay the monthly and the annual fee because I didn't want to use that card because they had a 28% interest rate and they weren't coming down. So I
Right.
closed out the card and it hit me for 50 points for about 5 or 6 months. There's nothing that I could do about it, but I just had to continue to keep that payment history. When you have when your credit is just starting it off and maybe you have 2 or 3 years of credit history, and this is just to address the question, the main thing you want to do is find somebody with good credit and attach yourself to one of their cards that has like a $10,000 balance if possible. And let me just tell you, just because you don't have good credit doesn't mean people around you don't have good credit. And if you got somebody in the family that knows you and that they're willing to help, let them attach your credit profile to their current Amex card that has a $10,000 utilization or $20,000 utilization. They keep their balances low, and your credit score is going to shoot up. And then there's no liability because you won't even have a card to spend. All
Right.
you're doing is just attaching yourself and going along for the ride to better credit. But you got to have that person in the family that's willing to extend that to you. That is in my opinion, is the real only way to expedite having 1 or 2 years of credit history and then getting your credit score where it needs to be.
Absolutely. And one of the things that I think we underestimate because we are such a consumer driven um, people, credit is not about buying stuff, it's about being able to generate equity because there are a lot of things that increase in value, like land, like other pieces of property that you can own, whose value increases as the longer you keep it and along, but you won't have access to that in a way that is economical if you do not maintain your credit. And stuff happens. I'm in a situation right now where last year, as everybody knows, my husband had a stroke and medical bill showed up. This bill showed up. I wasn't in the office. I haven't been doing the radio show. Um, all these things were happening, and my credit cards, who I had paid down to zero, I had to use them. I had to pay for a wheelchair. I had to pay for a prosthetic leg. I had to pay $1,200 for hearing aids. Just stuff. Okay, I got a $6,000 medical bill at John Hopkins. I had to pay that down and get rid of that. It's just stuff, and it allowed me to start using more of my credit than I really wanted to the point where it's way back up, well beyond. But you have to also, I think these things happen, but you also have to recognize it, and I think spend the time to of what's necessary to pay it back down. It can credit is fluid. Your credit score can be one thing today and something else next week, but it's about the long term pattern of behavior that allows us to become more financially independent. If you can pay your bills and pay them, know when they're due and pay them ahead of time. If you um if you can't afford to buy something and pay it off in the next 2 or 3 months, then don't buy it unless you absolutely have to buy it. And then, just like the gentleman said, work with family members to help you do that. I think we underestimate the impact of credit. We just want the stuff. We just want the car. We just want the house. And I'm going to talk about that more and more over the next few months as we talk about how our credit situation is affects our ability to do things. So the question is, do better drivers have better credit? No, not really. Auto insurance companies do, however, reference numerous studies showing a correlation between credit history and the likelihood that a consumer will file an insurance claim. Having a good credit score, or at these days, there's a whole, it's all big and elaborate now. At first, it was just pulling credit. We don't really show up on your credit now. We do what's called Nexus Lexus, which is owned by Experian, has a program called an insurance score. So it's not a credit score; it's insurance score, where it's connected to your credit score and other rating factors to determine what your insurance score is and what tier you land in. As I said earlier, there is tier one, two, and three. Tier one, two, and three is based on your credit score and where you land. Tier one is called the preferred. Preferred clients are what farmers like to call confident planners. They own a house, usually multiple properties. They own several cars. They haven't had an accident in the last 3 years, and if they have, it's only been one, and it was probably not at fault. And they have a credit score usually of above 670, somewhere between 650 and 670. These are your tier ones. They also have what we call toys. They have boats, motorcycles, RVs, and different types of off-terrain vehicles. Um, these are what they consider preferred. Now, you don't have to own all of these things or have all of these aspects, but if you fit in one of those categories and your credit score is good, they consider you preferred. Within the preferred category is one, two, and three tiers. So, depending on how many of those things you have, if you fit in the preferred category, this is where you get your best rates. These are the people you can qualify for: AAA, Liberty Mutual, Farmers Preferred category. You're going to get your better rates, and it's going to be probably more commensurate with what you consider factors that are specific to you. I get phone calls all the time. I'm over 65 years old. I don't drive that much. I shouldn't be charged this. Believe it or not, men over the age of 60 have more car accidents than women between the ages of 35 and 55. That's just how it is. Why? Because that is how the statistics are showing up. And then you have your standard category. These are people who fall in the middle, whose credit score is probably somewhere between 600 and 650. These are people who probably also own property, but probably just their one property, their house. They may have two or three cars, probably don't have any toys, but they haven't had an accident in the last 3 years. And if they have, it was probably just one. You see where I'm going with this? And inside that standard category, there are three tiers also. And all of these depending on the number of accidents, where you live, how many claims you file, the drivers in the household, whether or not they have tickets, and all of that. And a lot of people get upset because they think where you live is such a big factor on what your car insurance is. Where I'm going to do a show in a couple of weeks to talk about rating factors for location. We're going to talk about all locations. We're going to talk about Virginia. We're going to talk about Pennsylvania. We're going to talk about Maryland and why different locations rate differently and why those exposures exist. I'm going to go over that in detail. But believe it or not, before you even get to those specific rating factors, what goes into place is credit. It is determining your insurance score, and your insurance score, which is calculated by a company called Nexus Lexus that's owned by Experian. Your insurance score determines what tier you go in. So you have that standard tier, and then you have substandard. Substandard are those individuals usually Not always, but usually who don't have any prior insurance. Those individuals whose credit score is below 600. And it doesn't matter how far below 600. Below 600. You also looking at individuals who may have 2 or 3 accidents or have exposure to youthful drivers that have had a couple accidents. Youthful drivers can be in the standard, in the second tier, okay? But usually if there's several accidents or situations, they're in the third tier. The third tier is where you get your highest rates. And the thing is, people think that they can't get out of that tier. You can. Just like you build your regular credit, your financial credit, you can improve your insurance score. You can improve your insurance score by, if you can afford to cover the cost of your claim, cover it. Self-insurance is a big factor and it matters. That's number one. Number two, the drivers in your household. There are certain driving behaviors and patterns, which is why you got all these insurance companies giving you those little fobs to stick in your car, or those little fobs um, to carry the app to download on your phone to track driving behaviors. Because certain driving behaviors, whether it's stopping suddenly, the time of day you are on the road, how often you are speeding, that contributed to tickets, that contribute to accidents. All of these things go into factor. Watch your driving behavior. Take a look at, am I following too closely? What time of the day I'm on the road? I know if you have children and you got to get the kids to school, you can't help but do that. But if you can leave a little earlier so you're not on the road when other folks are, or leave work a little later so that you're on the road after rush hour, all of those things go into factor in whether or not you are contributing to behaviors that cause you to be in situations that can create accidents or incidences. I used to ride with my aunt, and she would park all the way down the end of the parking lot. And she was like, "Oh my God." I'm like, "Oh my God, can we park up close?" And she like, "Ain't nobody dinging my car. Ain't nobody doing this." And I understood that because anytime that occurred, that contributed to something that had to be fixed or claimed. And it's not being picky or being materialistic, thinking that the car is more important. It's not. It's been a good steward of the things that God has given you. That's how important it is, being a good steward of the things that God has given you. And using those things to multiply them. Be the person with the 10 coins that the master gave to his servant, and he went out and reproduced it and created more from it and was able to share with the people around him. That's what this is about. It's about being a good student of the things that God has given us, magnifying them, pressing them down, multiplying it, and flowing over. That's what we want to do. And hopefully I am giving you the tools to help you do that. At the end of the day, there are many skeptics who insist that there is little correlation between your credit and how good you drive. But the reality is that credit can often impact auto insurance rates. We can't do that. We can't do anything about it. The Maryland legislature passed the law that said that they can use credit in determining risk factors. It's just how it works. It is what it is. What I can do is to give you the tools to help you improve your credit. We want to thank Mr. Ron Johnson of All Financial. If in fact you want to reach out to him, he can be reached at 877-740-9840. His email address is info@allfinancialservices.com. And he's located at 10989 Red One Boulevard, Suite 210, Owings Mills, Maryland. We're going to put this in the chat as quickly as we can to air so you guys can have it. He works with individuals who want to improve their credit and help them get what they need. Um, and his name is Mr. Ron Johnson. So listen, there are several things that you can do to improve your credit. He talked about some of them using a relative who has good credit by getting added as a additional user, but not actually having the card. You gotta have a good relationship with your relative to do that. One of the things a tactic I used was I called or I went online to all of my credit card companies and I asked them to increase my credit limit. That allowed my utilage to go down because the amount of credit that you have available to you is higher. And of course, the third one we already talked about, an authorized user on someone else's account. The second one is to pay your bills on time. Normally, I pay more than what's due, but even if you can't, at least pay the minimum. Whether it's $30 or $25, at least pay the minimum. I try to get my stuff paid off as much as possible. That will allow me to get the credit down, put more toward credit and less toward interest. One of the other things you can do is get cards that allows you to pay off without interest under a certain amount of time. This is important because it's the interest that's going to kill you in the long run. The other thing you can do also is get cards that give you points or allow you cash back. Because I often use my cash back to pay my credit card or use my points to do something else. I have a couple of cards like that. This article in Personal Financial Nerd Wallet is saying the portion of your credit limits you are using at any given time should be less than 30%. With lower, but the lower is of your credit utilization on each card, the better your credit score profile. If you want to make sure your balance is low when the card issuer reports it to the credit bureaus, because that is used in calculating your score. Simple way to do that is to pay down the balance before the billing cycle ends, or to pay several times throughout the month and always keep your balance low. It is a time commitment because you need to be watching your stuff all the time. If you are not, then things can get away from you. But we tend to just want to do it when we want to buy a house. I'm going to have a guest on here in a couple of weeks that's going to talk about homeowners and buying house and what real asset development is, which is property. You can always dispute your credit report. Everybody knows about that. If there's an error, if they're accusing you of being late when you are on auto pay, you can always go in there to dispute it. If the company is no longer active with you, and they don't respond within 30 to 60 days, not sure what the time limit is, then it has to come off of your credit. According to this article in NerdWallet, it says 30 days. If you have a collection, deal with the collection account. Pay it off, and then after 30 days, ask the collection company to remove it from your credit report. Or you can dispute it after 30 days after it's paid off. And if the collection company doesn't respond, it can come off your credit report. But if you owe money, you want to pay it. You want to put it on your list of things to do, even if you're paying $10 a month. As long as you're paying on it, it reflects better than if you just let it sit and do nothing. A lot of the credit bureaus also allow you to get credit for your rent and your utility payments. That is important because that is unconventional credit and allows you to use the things that you are paying on time to reflect your payment history. It's really important, and it can be utilized in ways to help boost your score 20, 30, sometimes 50 points. It is not unrealistic for that to occur. It is not unrealistic for you to be able to access that. The last thing is credit mix. One of the things, revolving credit affects your credit most and quickly and frequently, but you also want to have a good amount of credit mix. You want to have your auto loan, you want to have your property loans, you want to have your credit cards, you want to have your personal loans, you want to have a good amount of credit mix, and you want to pay all of them on time. On time, on time, on time. We all mess up. We all get into a situation where we don't have enough money, but paying your credit cards and the rest of your bills are important. They are an important part of maintaining your financial health so you can do the things down the road to be able to create financial independence. You want to be able to, I don't know, retire quickly, or you want to be able to stay at home 2 days a week because your money is making money for you. We're going to talk about all of that this year, how to do it, what to do, in the direction we are going in, and the opportunities that are occurring in the market, and how does insurance contribute and help you out with that. So today we're going to wrap up. My name is Ramona Jones McClain. I am your insurance guru. I want to thank my audience. I want to thank those individuals that chimed in. We are here every Thursday at 3 p.m., whether it is a pre-recorded show or whether it is a replaying of a show. However, we plan to try to be live for the rest of this fall. And if you, in fact, want to contribute to the show, we appreciate it. If you watching us on YouTube, there is a barcode that you can go and scan in and make a donation. Or if you want to call here and get a rate for your insurance, we are here. We are ready to receive your call. That number is 443-660-7131. We ask you for your patience as we gear back up and assist in redesigning the show and helping to do what we need to do in order to improve the financial strength of our community. We appreciate you. Remember, give us a call at 443-660-7131. Check us out on Facebook at Ramona Jones McClain Farmers Insurance Agency. Check us out on Instagram as well as YouTube. And you can go to our website at insurancegurumd.com. Thank you so much and have a wonderful day.
Hello, Ramona. I can't shake the simplest feeling beyond the ghost. We stand on the opposite shore. Hello, Ramona. I reach through mysterious ceilings. My home